It's Mark Bauer. Tonight I'm in the city that never sleeps. I got to New York this morning. I have some business meetings this week. So I had a great dinner with my niece down on the east side. Great little Italian place. Back of the hotel, enjoying a glass of wine. Cheers. What I thought I'd do today is again focus on the question of business value, your enterprise value, and try to address one aspect of that. Remember, I said there's three parts to your value, three things that have an impact on what your value is going to be from an investor's point of view. One is your profit. We talked about that last week. Another is what risk is associated with you and your industry and your business deal. And the third I call is how well you present yourself. You know, how much competition you create for your deal, and what kind of compelling story you tell to a potential investor. Those things are going to impact your value. The challenge is the only one that's a real number is your profit. The other two, really, you can't put a number to them. So how do you figure out what somebody might invest in your practice? Well, what I want you to understand today is the concept of a multiple. So a multiple is basically how do you put a numerical value to risk and presentation and those sort of things. And so there are many sources out there that you can find. They're usually pricey. The one we use is very pricey. But there are many sources where you can find historical data on transactions. So what you would do is you would look at a transaction where somebody got financing for a business in the same industry you're in, and you would look to see what multiple was used. And so that means if you saw that a company got valued at $20 million and they were making $2 million, in essence, the imputed multiple there, the multiple is a 10. So that means they got paid 10 times their earnings, 10 times their profit. So you can kind of see the history and trend of different industries by looking at histories of multiples in different deals. I want to show you a chart here. It's a chart of the history of multiples in the major sort of industry categories. And what you're going to see from the very beginning is that real estate deals still continue to hold the highest value. That means $1 million made in real estate is worth substantially more to an investor than $1 million made in the energy business, oil and gas, anything energy related. And that makes sense. Real estate is consistent. It's not as volatile as energy. You can see here in this chart the trend of energy as soon as the price of oil went down last fall, to drop tremendously. So you can see, you see how well investors think of the real estate industry, how well they think of the healthcare industry generally. If you want to look at a separate, at some of the more intricate components, or let's say some of the more components of a particular sector. So let's look at energy, for example, and you'll notice that the storage and transportation segment of the energy industry still has a very high multiple. That's because their profits are not contingent upon the price of oil. Their profit system is what it is, and it doesn't go up and down with the price of oil, where the drilling and production components in the energy segment, are much more volatile, and that's why they're perceived to be a riskier investment, and their multiples are farther down. If we look at this chart now on healthcare, what you'll see is that in the healthcare markets, you'll see biotechnology, pharmaceuticals. Those have much higher multiples. But they're also relatively volatile. They can depend on what's coming out on the market, what's hot. So it goes up and down, but they're still higher than things like a doctor's office. But you can look at a doctor's office and see basically the trends are consistency. We kind of know what to expect. So we'll talk in the future about how you can impact your multiple. But the thing I want you to understand now is you can find sort of a target multiple of what businesses are being valued at in your particular industry. And then your goal is, because a multiple is not a Kelley Blue Book price that you can take to an investor and say, this is my value, give it to me. If something's averaging a 10 multiple, it's probably trading anywhere from a 7 to a 12. And so there's a significant difference between a 7 or a 12. And your goal is to ask yourself the questions, how do I get at the top of the range of multiples for my particular industry? And we're going to go over some strategies for that. It's one of our upcoming sessions. So until then, stay tuned. Take care. Have a great night.